Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
G'day, how you going? Phil Tarrant. This is Property Investing Insights with the Right Property Group. Welcome. I'm your co-host. 9 years now this podcast has been running in a couple of different iterations, but we've kept true to the original purpose to inform and educate our listeners in and around property investment. And fortunately, there's more information in the market today than what there was 9 years ago. But with all that information in the market, I see more and more people making dire financial decisions sometimes. So hopefully you've been tuning into this. You've been down the right pathway. I'm joined in the studio with my co-hosts, Director at Right Property Group, Reshmi and Victor Kumar. Team, how's it all going?
Going well.
Going well.
Yeah, 9 years though. We'll look at it before we come on.
Long time.
Yeah.
You haven't aged at all.
Not at all, but you have.
I know. I don't know what's happened.
Yeah, I think it's all the pressure of keeping up with all the information, being the good journalist that you are.
Being the custodian and the steward of smart property investment
So the
decision making.
Oracle of information, is that what you are?
But yeah, I am, so I'm told. But I'm still of the position I don't know anything I'm talking about. But I have a bit of a bone to pick with our listeners, though, Victor.
Mm-hmm.
If that's okay. Not enough reviews.
I know.
Not enough reviews. We used to get heaps of them. We've been on for 9 years, consistently, every month for 9 years. Work that out. What's 12 times 9? You're a good maths person.
I have no idea.
Yes,
What's 12 times 9?
It's a lot of episodes, right?
I know it's less than 120.
It is less than 120, so we'll go with that. But every single month for 9 years, we've got together and spoken about property investment. People go, you run out of things to talk about. Well, that's certainly not the case. But some more reviews would be nice. What you know probably better than I do. I sort of get sort of results on how popular this podcast is, and it's very, very popular on the Property Investment Podcast Network, and for those of you that watch it directly on the Property Investing Insights Network. So I get a sense for how many people are sort of listening to it and watching it, but are most of them your clients, or what do you reckon? Because they should be giving us reviews.
Yes, for the clients, there's no excuse.
Can't say it,
there's no excuse. If you want to be in my good books, give us good reviews.
You look right. You go. So what happens? So I'll tell you, Victor sits there on his phone and goes, "Okay, review." So when you call, he actually picks it up. If there is no review, he goes, I'll get back to them. So it matters.
That's right.
It matters. Be a player. Play the game. Play the game.
Now, so the listenership is very diverse, right? So we've got clients, we've got a lot of people that are looking for information, and let's face it, we're one of the first podcasts off the rank in terms of properties, right? So. Certainly, we've kept true to the formula that we started off with: is keep everything factual and put ourselves as the voice of reason in today's market, where we are so infiltrated with too much information to then filter it down to say, okay, these are the fundamentals. This is what you really need to look at. And if you're finding this of benefit, please do give us a 5-star rating and write a review. And also, while we're on the same vein, questions@rightpropertygroup.com.au. If you wanted a topic for us to talk on, that's the place to send your emails.
Absolutely, and that is picked up, and the team do filter all those, and a lot of it comes back. And we like the positive words directly, but it'd be nice to also see it publicly there on those reviews wherever you tune into it. And there's also a big team behind this that do the heavy lifting. We sit here on microphones, but there's producers and organisers and digital people who are all sort of involved in this process, so they get a kick out of it. As well. But Victor, 9 years is quite a long time to be recording this, and we've covered, I think, pretty much every facet in property investment, but there's always something new and different around the corner, and we're certainly in that scenario now. And this is part of our series on Design Your Decade, and today specifically I want to talk about the fourth D, which is diversification.
And direction.
And direction. And for those of you who tuned in prior and you go back and tune into it, we've spoken about diversification, defence and debt. So this is the fourth D, direction, but probably the fundamental aspect of all property portfolio construction is direction. Direction changes. Direction you need to be nimble. Direction you need to be responsive. Direction you need to be proactive as well. But before we get into direction, I want a bit of a market update because much like you, I knock around property a fair bit, and Reshmi, and I was tuning into your new podcast the other day.
Okay.
Tell us about that very quickly.
Oh, well, it's a Property Investing for Women
Yes.
podcast. I've been doing, I've been investing for a very long time, though I've been in the, not in the forefront. After the first 10 years of our investing, I took a step back but I've been doing a lot of work still, so I thought, it's time that I could share my knowledge. So there is that podcast, which I tried to do many times, attempted over a couple of years, and I wasn't happy, and I thought, no, I just put it out. And so I started in May. I thought, there we go, it's done. And so people are liking it, and I'm really excited. Like people are giving me comments, unlike
Really?
yours. Yes.
That's good.
She's a
that's-
perfectionist. That's what it is.
That's
Yeah.
90% of winning is beginning.
Yep.
Yeah,
that's
so
it.
I was very happy that I managed to actually publish it, and it was,
Very
it
good.
was good.
Are you
Yeah,
going to invite
it's
me
growing.
onto it at any point? Will I get invited?
We have to wear a skirt to get on it.
Oh, no.
Yeah.
You can't say that. It's 2025, mate.
Yeah. No, it's
You see what I
it's
deal with
good.
here?
Be in
know?
touch with your feminine side.
Yeah.
That's good. There are some men listeners in there.
I'm sure there is.
Yeah.
You know,
Yeah.
I'm sure there is. And I've spoken a lot about this over the years, and there's always been a small challenge getting female talent onto the podcasts that I sit in. Maybe it's me, but what I've found, and I've got to be very careful here because I don't want to say anything that's going to get me in trouble. But this is just my observations. The very quiet hand that women play in manufacturing and creating direction in property investment decision making cannot be understated. Their fingerprints are all over most portfolios I've seen. They might not want to actually sit behind a microphone and talk about it.
No.
But I'll tell you what, not a lot happens without them in
They are
the
the
background.
key. They're
Absolutely.
the key in the
Absolutely.
household, and they're the ones who are focusing and kind of guiding the whole thing. It's life. And so your spouse, your partner, or alone, even if they're alone, they're the ones, behind that, guiding that man and like keeping things in check. And so a good sounding board, you've got so many roles as a woman. You just do so much that is not, you are the support. And if you are not, if you don't have that knowledge and all that, and then your man is out there making all these changes, or even if you are doing it yourself, like there's just so much, the feelings and the emotions and the thought process, they're more visceral and a lot more in tune and gut, and then comes the finance, and then comes the actions with buying the property. So it's a lot more, that is the foundation. So the woman is kind of looking at things in a more holistic way. And
Risk
it's
and
very
governance
different.
and
There's so much.
de-risking and all the stuff we've spoken about on Design Your Decade. You absolutely said that, but that's it also. That's maybe viewing it in a more traditional sense. I've seen some very independent and driven and focused females out there absolutely killing it in property. And it's great to see. So please come on to the podcast that I do if you're out there doing that sort of stuff. But we'll get into a direction. A lot of those is orientated towards that. But Victor, I just wanted a bit of a around the grounds of what's going on at the moment. And I cover a fair bit. I'm very fortunate in my job. I get to speak to a lot of people around property and property investment. You're in the trenches, Reshmi. You're in the trenches every day working on this stuff. I sat in on a briefing last week with Agile Market Intelligence, which is doing a lot in and around property and finance. And I had Eliza Owen speaking out, who's the head of research at Codelity, which is the new name for CoreLogic. RP Data become CoreLogic. CoreLogic becomes Codelity, and it was a bit of a New South Wales specific presentation because it was in New South Wales. However, there was a couple of things she said which I picked up along the way, and one of them was she telegraphed greater oversight of APRA, the prudential regulator, in and around lending. And this is something I've been chatting about, I think we've spoken about beforehand. APRA there is to govern how lending is conducted and ensuring there's not too much risk in the system. And some people will see them as a policeman sort of slowing the market down where required or speeding it up, and a lot of recommendations around buffers, a lot of recommendations around shaping lenders' appetites, behaviours for growing the investor book. But she flagged it, and I really clocked it and collared it. The next day, there was a big story in the Financial Review on the front page around it that APRA is certainly looking at lending at the moment, and two key areas. One was high debt to income ratio mortgages, and the other one was around investor lending. Now, some of the data that Eliza shared was that investor lending as a share of total lending by volume nationally is up to 40.7%. In New South Wales, it was 46.7%. That's out of kilter.
That's huge.
So something's not right there.
Yep.
So obviously, they've been watching this sort of steadily track up, but it had a big spike over the last year or so. The other thing was high debt income ratio mortgages, and I think a lot of that is probably going to be targeted at this 5% deposit scheme.
Yeah,
so these are the second, third, fourth order impacts we've spoken about this 5% deposit scheme, which I think is probably going to go down as one of the most stupidest policy decision makings that's probably has ever taken place in and around property. Because, hey, let's fix the affordability problem. You just cascaded and extrapolated affordability issues for everyone in the future, and you've tied in Australians to debt that's a lot larger than they want to. Now, intersection with that is that we see some lenders coming out of trust-based lending. So, cynic of me says they're probably chasing first-home buyer stuff, which is, guaranteed by the government. Why would you sort of chuck a stuff in investor lending, dial that down, fix these problems, put it up there? Now, that's not going to help things, but that's the environment we're in.
That's true. And this is not foreign environment. We've seen this before, where the 2018-2019 market, where lending changed on its head, where APRA had come in at that time and said, you know what, I don't like the fact that you, Mr. Bank, have got too much tilt towards investors, and therefore I need you to be responsible lenders, and you can only have 10% of your growth tiered towards investors, as opposed to having the bulk of it for owner-occupiers, right? Because they're trying to reset the market without it having a runaway effect. We've also got a compounding factor here, which then ties into the data, is the fact that we've got one of the fastest growth industry that's happening in Australia, which is the buyers advocacy, buyers agency industry. And so if you look at bulk of these buyers agents, they're more focused on investors. And when they're focused on investors, we're not talking about a cohort of investors coming in to buy in an area. We are looking at a cohort of buyers agents that have got transactional volume coming in to buy in areas. And so naturally there is a bounce in investment lending, and there is a bounce in value. But then you've got a question, is the bounce in value due to fundamentals, or not so much investor-led activity, but buyers agency-led activity?
Yeah, I've been pretty vocal around the dynamics of this playing forward now, but just to touch on the point you made. So if you've had this accelerating industry and all the rhetoric that comes around it, right? So if you're changing, and this is really interesting, compounding. And by the way, I added up nationally investment lending as of September 25, and first-home buyer lending represents 61.6% of the market at the moment. It's investors and first-home buyers. So think about this, right? There's all this information out there saying, don't buy a home, rent where you want to live, and invest where you can use it as a vehicle for wealth creation. So you're creating more renters.
Yeah.
But and extrapolating that even further, you're creating more rental stock. So you're fundamentally changing the inherent balance between rentals and owner-occupiers. And that's what's taking place right now. So you would expect there to be an increase in investment lending because you're getting less people buying their own home than traditionally they would have, and you're creating more rental properties. Now, that's great from an affordability point of view. Inversely, you're pushing prices up, which you're making it even harder for people to buy their own homes. So therefore, they're stuck in a rental market. So what will happen if it continues down that pathway? You're going to end up with a lot more people renting than owning their home. At the moment, it's about 2/3, 1/3, right?
Yes.
If you go back 60, 70 years, about half of people were renting.
Yeah.
It's a reasonably new phenomenon that you have as many owner-occupiers as you do compared to how it was maybe pre-World War II.
It is a change of guard, right? So we're going down the path of New York, where you've got majority investors. So home ownership is far less in comparison to investors. And then we've got institutional investors where they're doing what we're trying to do over here, which is the build to rent scenario. And then when you also add to that the fact that we are now getting into home ownership a lot later because of lifestyle, because of where we're living, and because also of the affordability factor. Can I actually get into the mortgage? I mean, most people, they want to go to age 30, 35, 40, living life, and then they realize, okay, I better put down roots. Yeah. So that's when they start looking at, okay, where's my deposit coming from? A la the 5% with the government help, which is necessary. And then the next thing we're likely to see then is a increase in the tenure of the mortgage, right? So it won't be long before we start seeing 40, 45, 50-year mortgages, right? So gone will be when we started investing, it was unusual to get 30-year mortgages. It was 25-year mortgages. And now it's not unusual to start talking of 40-year mortgages. There are a few lenders that are actually doing 40-year mortgages because you're then talking far less repayment because you're stretching the time. But just as importantly, you are also, as part of shaping the market, you're getting into a whole lot more of cash flow debt. So what I mean by that is that you're taking, it's stretching the mortgage another 10 years, and therefore you're paying another 1/3 more of the repayments. So what you started off with, in terms of, if I can bring the analogy of buying a car, right? If you've taken a loan on it, by the time you paid back, you're paying back almost 1.5, 2 times. Yeah, the car, the home would be more so like 3 times the original debt,
which is quite alarming and scary for a lot of people, and you're tying people into that scenario moving forward. But that's the nature of the market, and supply and demand is the core issue here, and right now it's out of imbalance, and we're seeing it here for some of the things we spoke about. And I do note also, I think a couple of days' time, every single person with a HELP or a HEX debt is going to have 20% of it wiped off. So
which is good.
Maybe.
Yeah. I'm miffed that with my daughter, I actually then decided to pay direct after the first payment because I did the calculation, right?
This is the problem, right? Like, it's I personally have a bit of a problem with it as a scheme. Like, why should only a cohort of Australians get the benefits of taxpayers, dollars, and for what we're paying to wipe off all those HEX debts, you could have bought the whole F-35 Joint Strike Fighter campaign for Australia, the purchase of them, just relevant, and also the maintenance of it, which benefits all Australians, right?
Yes.
So, but you're going to have more people now in the market who are all going to be, not paying off a HEX debt, who are now going to be probably subscribing into this 5% scenario.
Yeah.
So what's going to happen?
Prices go up.
Price go up. But anyway, so what's happening with price across the country? I'm told here by the Australian Financial Review, Victor, that Perth prices tipped to jump up to 16%. So this is a report that goes out every year by SQM, and there's normally 4 scenarios. So the base case for it is 0.25 to 0.50 rate cuts from mid-2026, slowdown in the economy and inflation, scenario 1. Scenario 2 is sticky inflation, no rate cut until late 2026. Inflation sort of sticks 2.75 to 3.2%, slower economy. Scenario number 3 is a global slowdown, 0.75 to 1% rate cuts in 26. Unemployment goes to 5.5, and then scenario 4 is economic rebound. There's 0.5 to 0.75 rate cuts, lower inflation, unemployment back to low 4s. So on that basis, scenario 4, it's going to be 10 to 14% growth average across all of the states. Scenario 3, 6 to 10. Scenario 2, 4 to 8. And scenario 1, 6 to 10%. So on that 6 to 10%, on the base case 1, that's Perth growing from 12 to 16%.
Yep. So part of it is also the herd mentality that will create that growth. When it becomes more affordable, more people will jump in and becomes part of the social proof that we have more and more growth.
All the buyers agents throughout their manufacturing.
Yeah, absolutely. Yeah, that's right. And I really think whilst buyers agents is a thing that is going to be mainstay of property industry in Australia, I think the next 5 to 10 years is going to be the tell in terms of what financial damage is done. Mind, there's some really good buyers agents out there, right? And it's understanding that it's going to become volume driven, and therefore the volume will dictate the price rather than the fundamentals. So things like 60% growth in Perth and all that would become the norm, and which is even more probability that APRA will step in to slow things down.
Yeah, they're going to put the brakes. So that's on that. So scenario one is the base case, right? So this is sort of assuming this is the way it's going to play out. And they're telegraphing 0.25 to 0.5% rate cuts from mid-2026. Not sure if that's going to happen. So Perth, 12 to 16% growth. Brizzy, 10 to 15. A lot of that will be sort of Olympics-led. Darwin, 12 to 16. That's a bit of a moon at the moment. Melbourne, 4 to 7. Sydney, 3 to 6. Adelaide, 10 to 14. Hobart, 4 to 7. And Canberra, 3 to 6. So growth all over the place. Melbourne's interesting there because everyone's talking about Melbourne now. I think you mentioned to me some time ago that you had concerns and worries about Melbourne, that a lot of the growth is not being led by baseline fundamentals. It's pretty much, in many ways, buyers agent led. Do you reckon, Reshmi? Yeah.
I think so.
Yeah.
Yes, we are coming across a property with so many offers from buyers agents.
Yeah.
And so, we get that. Yeah.
In fact, it's coming to a point where some areas where the valuation is not stacking up because the lender's putting a risk rating on it.
Yeah.
And one of the questions valuers are starting to ask is how many of these offers were from buyers agents?
Yeah.
Yes.
Yeah, so that's a clear tell that even the lenders are starting to sit up and take notice to say, hang on, this is not fundamental growth.
Yeah. Well, the thing with buyers agents, particularly in Melbourne, and I'm sort of looking at a place right now, my super fund down there, just to have some. I've got other stuff down there, but I've had it for a while. Just to have something down there. Personally, I'm not convinced with Melbourne.
Yeah,
you know, I've pockets, yes, but I do have my concerns and reservations, largely driven around and buyers agents. And question I have for you, Vic and Reshmi, is you've been doing this for 15 plus years, nearly 20 years. You've seen many different markets. Now, there's a lot more buyers agents out there today than what there was back then. You probably could have counted them 20 or 30 of them, right? The buyers agents you see on social media ranting and raving and telling you all the things that you want to hear versus the buyer's agent that still goes about their business quietly and with methodology and without all the glitz and glamour around it. The buyer's agent that you don't see is often the buyer's agents who's doing the best work.
They achieve the results.
And I'd certainly put you into that bucket. You're working on something for me right now. We'll be able to share that at a point in time. But there's no razzmatazz and glitz and glamour around it. It's
brass tacks.
Brass tacks, boring, methodical work.
Yeah. So you need to be, lining up with someone with stature as opposed to a noisy presence. Because there's only so many fundamentals within building a portfolio. That does not change. I mean, if you look at the APRA tilt, right, that's come around again. So we need to be looking at it from that viewpoint. And if you take it back to direction, one of the first things that you do when you start seeing news snippets like this is you got to cash up, right? So you're really looking at anticipating that lenders will reduce the loan to value ratio, lenders will restrict lending, lenders will perhaps charge a higher rate for investment loans. And now would be the time to reset your lending in anticipation of this happening so that you're cashed up, because as we keep saying through every podcast, is that being prepared, being cashed up is the bit that puts you miles ahead of the other players. Yeah,
and if and when these spree breaks are put on, which will happen, the brakes are put on by APRA, it's going to slow down things considerably from an investment point of view, and whether those restrictions are going to be back on banks, we don't yet know, to curb growth in their loan books, or really find other ways to really tighten up restrictions that could even increase serviceability differences. Looking at these numbers here, top line, Adelaide looks like a star performer, irrespective of the scenarios that have been laid out here.
Yeah.
You know.
So
let's go around the grounds quickly.
Yeah, sure.
Let's talk about Adelaide.
So let's start with Adelaide.
Sorry, Reshmi, I know I'm hogging him at the moment.
No,
but,
good. I'm just watching all this and thinking, it'll take a really long time for everything to settle down, because when one thing is striking up, like the buyer's agent's activity, then the lender's trying to put a hold on things, then something else happens. So this will take a good time for everything to settle down and become at a normal playing field, and then we can say, okay, what is the normal?
Which should be 5 to 10 years down the track.
10 years is what I'm looking at.
So if you come back to Adelaide, right, and this is where if you look at the figures that are being touted, and you look at which states and which cities are being touted, the ones with better yield are the ones that are being touted as having better growth, right? So it's the affordability factor, it's the ability to hold on to that investment, then that gives that social proof of, hey, I can hold on to this, so therefore I can pay a little bit more. And it becomes the bit where everyone's going into the same area because they're now chasing yield. And if you bring it back to fundamental investment, and if you're just starting out, you really shouldn't be chasing yield within reason. You should really be chasing growth, right? Now, whilst the stats show that, and the projections show that you're going to get more growth in Adelaide, you're going to get more growth in Brisbane, you're going to get more growth in Perth, we need to also look at what their cycle is, as to how long each cycle is, and then also look at cost of replacement, right? So whilst Brisbane and Sydney is single digits, we are still buying these properties far cheaper in here, and it'll be a matter of time before it turns around to the growth happening in Melbourne, the growth happening in Sydney, given the fact that the puff in the market will dissipate in the states where it's easier to hold on to properties, because they will then become harder to hold because the prices move up, the rents won't move up in line, and it'll be what Victoria is right now.
So this story here, and Adelaide's a great case study because the subdued forecast for growth, according to SQM in Sydney and Melbourne, and this comes back to fundamentals and the fact that Melbourne might not narrowly the fundamentals, is softer immigration, and most migrants arrive in Sydney and Melbourne. So when you look at Adelaide, however, you've got different inherent drivers around it. But the report flags here, again, the APRA has concerns about the 5% deposit. But a key thing that jumps out for me, and by the way, SQM reckons that's going to be 2 to 3% of growth is going to be driven by that, is APRA looking at residential mortgage lending, which is limits on a high debt to income ratio. So they might subdue that a little bit. Investor and interest only loans. So the opportunity could be strategically and tactically. And again, this is sort of connected with direction. You don't have to be investing in property interest only. Like banks take a different view when you're investing with P&L.
Yeah, absolutely.
You get a cheaper rate. You might increase your repayments, but
and some lenders actually look at it very in a good light, because they then give you more lending capacity if it's principal and interest as opposed to interest only, because the loading on the interest is not that high for their calculation.
Yeah, some of our properties we've done in
P&L,
Yeah, and it's a natural progress, right? So as you build up your portfolio, that's what happens. If I come back to Adelaide, it's not uncommon over there at the moment for something to pop up on the market with a listed price and it going 100K above. Yeah, and that's the market there.
In what price range? Like 600-700?
So we're talking below your 750s, right? So it's a prime owner-occupier budgets, and therefore it's one of two things. One is, of course, the competition with the investors, but bang in the middle of that is also the 5% cohort who are trying to get into their home. Yeah,
it's and you know, back to the briefing that I sat in, and I can't share these slides, but you know, I could show you. This is the
heat map,
a heat map of where our median values equal to or below the first home buyer guarantee. And that's Sydney, right?
Yep.
Like, it's a lot of Sydney. This fits within the gap. So the same thing would be in Adelaide.
Yeah.
You know, that sort of prime first home buyer spot is the prime investor spot.
Correct.
So everyone's fighting for the same stock at the moment, and that's driving things up. Brizzy, you know, I'm happy I invested in Brisbane many, many years ago. You told me to.
Yes.
And we've got quite a lot up there, actually.
Yeah. And so let's talk about what's going to happen afterwards.
Yeah.
Right. So yes, we're going to get this growth. Who knows whether it's going to be 16%? Who knows whether it's going to be 6%? We don't know. No one can predict the future.
Worst case 9%.
Yep.
Top case 18%.
And if we look historically, when these things come out, then it gets revised within a quarter because the direction of the data goes differently.
Yeah.
But let's say that it did happen. The natural thing then will be that there'll be a stagnation and a little bit of giving back of the price as well, as people get into trouble, as the area flows out of vogue, and you then have a prolonged period of holding on with no growth. Yeah. So if you look at our Minto property, right, when we bought that, it was 325K, and for 8 years we didn't see any growth. Yeah. But then it trebled. So growth, we need to understand, is not linear, and so a lot of people, if they've bought in, say, Melbourne, or if they're bought in areas that are not moving in price as fast as the other areas.
But recent, like now purchase, they're going to take forever to.
Yeah. So it's not necessarily Melbourne itself, right? But, if you're buying towards the peak of the market, it will go up, but then it'll go sideways for quite a while. And this is something that we need to, as far as looking at your direction of your portfolio, you'll have some properties where you'll have phenomenal growth, immediate growth. You'll have others where, you're sort of questioning yourself, why did I buy there when everyone else is buying there and have had good growth? This is where you take a portfolio approach to say, you know what, in 10 years, 15 years, it's going to correct, and the growth would be fairly equivalent regardless of where you bought.
But you've got to be able to hold for that long.
Yeah.
So
and direction is key. And largely, this is a discussion around direction. We've sort of been market centric up until now, but we can continue that because it's certainly interconnected. But direction, you're going to be leveraging different aspects to help you shape direction. And direction is essentially where you're going.
Yep.
So you need to have a goal in place. So where you're going and why. You're going to be using data. You're going to be doing analysis, and for many, it's going to be an analyst paralysis. Choosing assets, as we're talking about, choosing location, having clarity, and knowing when to buy and when to potentially sell, when to buy, when to hold, and when to sell. But in terms of direction, this is where you need to be very cautious, because if you take this baseline assumption, and right or wrong, maybe I'll be proven wrong, that the inherent drivers do not support the growth that Melbourne has been experiencing up to this point. And this report would lend itself to some areas specific. And this report again says, yes, there'll be maybe softer migration. And I see today they're talking about curbing government spending now. There's going to be, drying that up. But this report says that the Victorian and New South Wales economies aren't very strong. Melbourne less strong than the Sydney market, from the New South Wales market. So these are the baseline inherent fundamentals around it. So if you're following the herd, to use your term, investing in Melbourne right now because you're told that that's the place to be, I tell you what, at best case, this is an economic rebound, and Victoria specifically needs an economic rebound rather than spending money on machete bins to fight crime. So absolute best case, 7 to 11%, right? Absolute best case. Sort of worst case scenario, which is inflation remains sticky, and Reserve Bank Governor has been very clear on this. They've got concerns about a sticky inflation, and there's no rate cuts, which if you read the last minutes from the Reserve Bank, maybe 2026 might not have anything. Melbourne, you're looking at 2 to 6%. So every other capital other than Canberra is going to be a better place to invest because of those fundamentals.
Yeah. And if I look at it from what we've been doing in Melbourne, we're paying 150, 200K more for the same thing from a year and a half ago. So there is growth there, right? But we need to be focusing. So when we're looking at these sort of figures, we're looking at averages. we need to find the pockets where there's fundamentals. We need to find the differential in terms of value. So, what's brand new selling for, what's the per square meter rate of land in that area, and buy accordingly, so that, the direction of your portfolio remains in line with what you're trying to achieve, so that you're actually buying the right types of properties, right? So I'm going to go out on a limb now.
Ooh, here we go, Reshmi.
So if we look at...
Lawyers are standing by.
Yeah, I know. Live dangerously. If we look at Ballarat, it's the absolute flavor of the month, flavor of the year, flavor of everyone's investment. The reality is that now valuations don't stack up in there if you're in the wrong pockets.
So vals currently aren't stacking up.
They're coming back 30, 50K below because people are paying that much more, plus the risk factor that the lender's putting in. And
also the buyer's agent's
Yes.
activity is what is,
dictating that growth, right? So if you look at when Perth had its hiatus, so areas like Maddington, Gosnells, all that, when the buyer's agents withdrew initially, it dropped. It dropped 5 to 7%, in some cases 20%. But then now it's taken off again because affordability is back in, right? So, except now with over there, if you really drill down into the data, it's more the home buyers that are creating that value, and now the investors are following.
Yeah.
Whereas in the last couple of years, it was investor driven, and the home buyers took a backseat because they couldn't get in. Because we, coming in from Sydney, Melbourne, Brisbane, we had deep pockets in comparison to what Perth offered.
So it's like there. So shaping your direction is not static.
No, it's not. No.
So you're always moving, always thinking. And Reshmi, even with your portfolio, I imagine you're always thinking about, which way we're going. Is it the right way? Querying, being
all depends on
inquisitive.
the finance, what is happening and what have you got available and what the market is doing at that time, whether there is opportunities to be made or whether you just sit back because it's just gone too crazy and it's not worthwhile buying right now, unless you find a really good opportunity. It's always what the activity in the market and the finance. So
We let go of a good opportunity because we've got certain direction we go.
We didn't want to tie up our money into an opportunity, which was awesome, because right now in our life, our direction, because of our home got approved, the focus is building the home.
Yeah. Well, you only have
And
so
so-
much capital, right? You got
Right.
and direction is really fundamentally where you deploy your capital.
Absolutely. And so we decided not to take up this opportunity. It was like, I'm like, this is really good because I know property, right? How you make money from the properties. But then it's like, how much, do you want to do that? And I want my home. So, okay, let go of that couple of mil that we could have made.
And that's now coming, dialing back into direction of the portfolio, right? So we know that with our home, lending is going to be harder because it's first of all, it's overcapitalized.
You got to overcapitalize your principal as a resident. Come on.
And then also it's on a scenic reserve, so that's going to make lending harder. And then it's got a heritage listing, even harder. That would mean that we'd have to tip in a lot of capital into this rather than getting a construction loan. So we've decided, we'll put acquisition, because we're always acquiring. We're selling down. A portfolio should be dynamic depending on what the goal is. So we decided we'll put acquisitions on hold to get this out of the way before coming back, because we can always catch up by changing the type of property we're buying, changing the opportunity. And this is where most people get it wrong in terms of direction, is that they just, you need to have a strategy shield. Yeah. So that you're shielding your strategy with everything that's coming along. Like Captain America, I now have the shield up.
This is what I was thinking of, fear, like when you're talking about that, it's like fear of missing out. That drives it as well.
That's right. Yeah. So if you look at reports like this, say Perth is going to be 16%, so people, I'm going to miss out on that 16% growth, and then they change their strategy to jump into that market. It has got some merit, But if you're changing it too dynamically, too drastically, you're going to get away from what your original goal is. So this is where the fear of missing out, the allowing the data to determine the strategy, as opposed to getting the strategy and getting the data to support that strategy, right? So I was in Melbourne, was it Thursday, Friday? We were talking on the phone and you were in a taxi.
Where are you going to tell us where you were in Victoria?
I'm going to.
I know.
No.
I'm going to.
Send all the buyer's agents there.
Yeah.
Okay.
I hear you're in Broken Hill, Victor.
Yeah. That's it. Very good buying in Broken Hill. Yeah.
Or Port Hedland, I think.
No, actually, let's boost up our portfolio. We're in Campbelltown. But now, to come back to that, I was 60 kilometers out of Melbourne CBD, right? And the data led me there where it was going to be, it had days on market was right down. The affordability factor was right in, right? So you could pay off your mortgage within 7.5 years in that area. So good income.
Okay.
Yeah. Then you had construction starts were increasing. And you had infrastructure, schools coming in, all that. And I had, young Stephen from my office booked in 8 inspections for me, because that's how one of the things you do is when you're going on the ground in a new area is you go and inspect properties so that you can talk to the agents while they're in their element to see what BS they feed you or what gems they give you.
So this is ground truth.
This is ground truth. This is where you're matching the data. So you're taking the data and giving it validation on the ground, right? Not the other way around.
Yeah.
So I drove in there, and the thing with Victoria and with Melbourne in particular, we need to understand is that clumps of properties, pockets of properties with vast open space. So that didn't faze me, driving past paddocks. But within 5 minutes, I was calling back Stephen and saying, cancel all of my appointments here. We're done here.
So how many appointments did you do?
None.
You just by driving into town?
Just driving into town.
So tell me what you saw.
Okay. One of the best research you can do.
Yeah.
Is going
McDonald's?
to the shopping, apart from McDonald's.
Get a Happy Meal. They've got a Grinch meal going on at the moment. That'd be right up your alley.
That's it. Absolutely. Yep. Come on, Christmas. I walk into the shopping malls, right, and you see who are the people that are shopping there at that time. Is there a young, vibrant population? Are the cafes full? And I also do the hairdresser test and the nail bar test, right? So how busy are they? So I just walked in and talked to the hairdresser and I said, yeah, it's pretty ordinary at the moment. So the data led us there, but we were probably 5, maybe 10 years ahead of the game in there. So it's just too early to invest in there. So this is where direction is really important, understanding and matching data to where you're going. So for someone that, let's say, they were early 20s, that was the only price point they could afford, and then they were going to go and do their thing, I'd be comfortable parking the money there. Maybe there are better areas, but I'd be comfortable parking the money there because I know I can come back and pick this up at 10 years' time. Yeah. But for someone that's in their 40s, they're building up their portfolio, we're focusing more on immediate growth rather than cash flow. Because cash flow is really good in that area. If we're going for cash flow, going for growth, that's the wrong area, right? So it's going down the wrong direction in terms of the portfolio. It'll stagnate you significantly. Your capital gets caught up.
So what's going to be the tells for you that it's time to go to this area?
We'll be periodically checking in. So every 6 months, 8 months, I'd be jumping in, sending the team in, looking at sales volume. So when we identify an area, we look at it over a long period of time.
This is the same scenario when you went to Perth. And the shopping centre was all empty.
Yeah. But I
remember having that. So just pre-COVID.
Just pre 2019.
Yeah, I remember there was Steve skulking around.
Yes.
And
And this is where we could see the momentum happening though over there. So we jumped in and started buying. We were one of the very first buyers agents that were buying volume up there.
Yeah.
And proofs in the pudding, right? So a lot of clients benefited significantly.
You still in Perth now?
Very sporadic at the moment. We're more in the inner ring than anything else. But now that you've given me this UB data,
Well, but what it says though is that those people that had the right direction 6 years ago and took your recommendations to invest in an area because you directionally were driven to that area, and it's good being, strategitic direction is important. It doesn't need to be perfect, but as long as you're sort of heading in the right area, you're gonna meander along the way, right? So those people that took action 6 years ago have probably had, at least 100% growth, trebled their money. That's like Western Suburbs of Sydney back in the early 2010s, right?
Yeah. And in your portfolio, we wouldn't buy Western Sydney anymore.
No.
Yeah, because it doesn't make sense in the direction of your portfolio.
I don't know what direction it's going. I don't think I have. Oh, would you say I have direction? Not
I don't know. You can't take direction
enough. No, can't. We're working pretty close together now on some stuff. I don't know if I'm probably the annoying type of client now that probably just knows a little bit too much. That I get in the way of myself.
Yeah. And that's true.
That's true. I'm absolutely first to recognise that.
Yeah. And if you bring it back to as your portfolio grows, you don't want to be operating off dated knowledge either. No. Nor do you want to be operating off the I've got a shield around me. Nothing can. I'm bulletproof as well, because it can hurt if you change the direction of your portfolio.
Yeah.
We're talking
That's
about
the purpose of what is the purpose?
Purpose is important.
Yeah, and that will tell you which direction you're going to go, because whether you go and buy and hold or do all these things in those areas, because your purpose is to come back to it in 40 years' time and then do something with it in your life, then that's fine. But if your purpose is to have a family and you live a fulfilling life with your family, with your children, and having maybe a holiday with a whole family once a year or something like that, and so that's what you want to achieve, and that's where you're focusing. So then that determines which direction you're going to go, and the direction you're going, that's where you're trying to head. But with the market changes, with the financial APRA and all these things that happen, you kind of have to, okay, this is where I'm going, but I have to go this way and then come back and then try that, and stick to those different strategies, use those different strategies and weave along to get to that.
I get asked all the time, what's the most important thing about being a good property investor? You probably get the same thing as well. And everyone says, I wish I started earlier.
Yeah,
starting early is really good, but it's not possible.
It's not possible. It's harder.
And not so many people think about starting early because they're busy enjoying life.
They're doing other things. You can only do that in hindsight, right?
Yeah.
They always say, I wish I did more than I did when I could have.
Everyone does that.
And I can say that as well. But I would, and that's all fine. But in terms of direction, Reshmi, I think that the most important thing about successful investors is patience. And I call it strategic patience. You need to have strategic patience. You strategically need to be patient.
Yes.
Because if you have a goal, you have an ambition, whatever that is, it's not going to happen overnight, particularly in property. And unfortunately, this is going to go against what a lot of people will tell you on social media. You make your wealth slowly in property, and patience is a critical aspect of it, because patience typically equals time, and that will help extrapolate out and help you with setting your direction. And directions change, but you need to know what that purpose and outcome is at the back end. Not enough people talk about being patient.
No. Everyone wants everything instant, right? So if you look at the 4 Ds that we've discussed over this mini series, right? So it's diversification, defense, debt, and direction actually comes as the forefront, because the direction then gives you how you're managing your debt, how the defense is managed, how the diversification is managed. But you mentioned that what's the deciding factor of property investing? It is actually the 5th D, and I've just made this up. It is the ability to make decisions.
Decision
right?
making,
Decision, and the speed at which you make the decision without being caught up in analysis paralysis is what helps you put the other 4 pillars, which is the defense, the debt, the diversification and the direction into play.
Can I add another D then? The ability to decipher.
Decipher's key.
Yeah.
Decipher. You need to know what you're looking at.
Yeah.
Because
Yeah.
and this comes to D for data.
Yeah.
You
So
have as
here's a
much
challenge.
data-
Here's a challenge to all the listeners.
Yeah.
Now throw in how many Ds
how
you
many
can.
Ds you
Yeah.
can get. But data's only as good as what you do with it, right? You know, data can help you, synthesize it and create
Data
something
is
from
there
it.
to prove whatever it is, but then you've got to go with the ground truth to
Yeah,
really
yeah.
use that to prove. Is it really?
It's the proof of concept.
Yeah, it is. But, and as we sort of go now into the back end of the year, 2025, and what a short year it's been, next time we get together, we'll do a big sort of outlook for the year ahead and what to do about it. But as you set your direction, I'll share here, and I'm sure I'm okay sharing this, and this is from the presentation briefing I sat in last week. Liza Rowan, who's head of research at Cotality, she said, here's her outlooks for 2026, or their outlooks. Home value increases are expected to soften in the short term amid a change in interest rate trajectory and affordability constraints. Correspondingly, new home values may also decline in 2026. Agree, disagree?
I agree.
These same affordability constraints continue to see Western Sydney dominate price growth, and further afield regional markets of New South Wales present an emerging opportunity for first-time buyers, investors and retirees.
Well,
Yeah.
that's where the population is being forced down that corridor.
Yeah.
They have to, right?
Yeah.
Yep.
So-
In response to affordability constraints, new development is also driving densification, another D, of more affluent areas like the northwest, where the new metro is up and running. But we need to more dense, and this is sort of infill stuff. While there has been no announcement of tighter lending conditions from a macro-prudential perspective, which you spoke about, there's mounting evidence that regulators are watching investor credit growth closely.
Pretty much. Yeah.
Absolutely. The headwinds in the housing market may be partially offset by persistent supply-demand imbalance in Australia amid elevated levels of migration and easier access to credit for first-time buyers. So,
That's already happening.
yeah, it's already all underway, but we'll go a lot more in depth and detail
Yes.
when we get together. And thank you, Eliza. If you haven't seen Eliza speak, she's very good, and one of the few people I turn to for real good strategic insights around properties.
See, one of the things, Phil, the benefit you and I and Reshmi have is the connection within the industry. So we tend to get information ahead of the general public.
Yeah.
And so we are able to then reset our mindset, look at it objectively, rather than reading it in the newspaper and having it crowded with the clamoring of multiple comments.
Yeah.
We get a lot more of the directional data as opposed to just general data.
Yeah, and directional data is key. And the data is only
Did
as
you
good
see
as
what I
each
did
other.
there?
I know, it was a lot of Ds. Good alliteration, was it?
Directional data.
Directional data. There you go. Maybe that's your new calling. So next time we get together in December, we're going to be talking, it's not far off Christmas, we're going to be talking about 2026 and what you need to be doing now for creating a better 2026.
That's right. Yeah. And if we can make the logistics work, we will have a very special guest at that time as well who's retired.
Oh,
using the strategies that we've taught.
really? A retiree? Are you ever going to retire, you guys? No.
Not me. I don't know about Reshmi.
The other D. You're waiting for the D for death. You'll be working directional. Keep going. You do it. How do people track you guys down? What's the best way?
So
You go.
jump on the website,
Yep.
rightpropertygroup.com.au. There's a contact me form there. Alternatively, you can ping us on the social media as well. If you've got a specific topic that you want us to talk about, questions at rightpropertygroup.com.au.
Yep.
And while you're at it, leave us a comment, leave us a
That's
5-star
everyone's
rating.
homework. I'm going to be looking next time we get together. I'm going to do shout outs.
Okay, yeah, let's
Yep.
do that.
Yeah. So use your real names. Don't use Victor 121. Which I'm sure. Have you given yourself a review yet?
No, I haven't actually.
Yeah. There must be I don't know how many clients have you had over the years?
I've
Thousands.
lost count.
Thousands.
I've lost count. Yeah.
Yeah.
So imagine if all of them gave us a review. We'd be the most reviewed property podcast
Pretty much.
on the internet.
Yep.
Yeah, there you go. And you haven't been doing it 9 years. It's certainly a commitment.
Oh, well,
Certainly a
we'll
commitment.
Yeah.
request and you shall provide.
There you go. All right. Thanks, gang. Good to see you both. Thanks for coming in. I hope you enjoyed that. Property Investing Insights with the Right Property Group. Thanks for tuning in. We'll see you next time. Until then, bye-bye.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.